Welcome to Boxes and Lines, a different kind of finance podcast from a different kind of stock exchange, featuring IEX founder Ronan Ryan and Chief Market Policy Officer John Ramsey. Now here to give you the straight talk on how the markets really work, it's Ronan and JR.
Welcome, everybody, to the latest episode of Boxes and Lines. Take it, John.
Welcome to Boxes and Lines, and welcome back to Ronan. He spent 2 weeks over in the old sod.
Welcome to 2024. This is our first podcast recording of 2024.
It's a brave new world and new year.
And as we embark into this new brave new world, we figure it's a perfect time to explore what the future holds in the world of ETFs,
and we have finance. A financial futurist to help guide us to look into the crystal ball.
Yeah, our special guest today is Dave Nadig. I'll give you some intro to Dave, and then he's going to tell us what the hell a financial futurist is. But he is, in fact, one of those at ETF Trends and ETF Database. And prior to that, he was managing director of ETF.com, which is obviously something we all know. He's been a go-to expert for insightful commentary on all things ETFs. And we will explain what an ETF is. Before his tenure at ETF.com, Dave managed mutual funds at startup metamarkets.com and was a managing director at Barclays Global Investment in the 90s.
And he also will hold seances for people to communicate with
ETF issuers.
with ETF issuers of the past for a small fee. But I just made that one up.
He's left the room. That was terrible.
That was it.
And he's also the co-author of a comprehensive guide to exchange-traded funds for the CFA Institute, a definitive book on ETFs. It reminds me of Austin Powers. That really is my bag, baby.
And it's
it's
a terrific read, too. I read it last night.
I don't believe a word of that.
There you go. So really quick, look, we appreciate you joining us, honestly, Dave, and we will be more mature in seconds. But
all evidence to the contrary.
Yeah, he said he's listened to us before, so he knows what he's in for. But let's play off your title a little bit on financial futurist, and just maybe tell us what exactly is a financial futurist,
and
or flutist.
And a little bit about Vetify, which is where you work now.
Sure. So let me start with Vetify. So Vetify, which has now been acquired by the TMX Group, who owns the Toronto Stock Exchange, among other things.
I read that. Yeah. That was just recently, right? Like over the holidays?
January 2nd.
Okay. Wonderful group of people there. We have very warm relations with the folks at TMX.
Yes.
Well, luckily, so do I. So that's convenient.
Yes.
So Vetify, you can think of us as sort of living in the intellectual property space between folks who want to issue investment products and financial advisors, who are the ones who generally are buying the bulk of these financial products. So we work with issuers to do everything from help them develop cool new ideas and turn those into indexes, and then those get turned into products. We don't make ETFs, but we help generate some of that intellectual property. We produce an enormous amount of content across a whole suite of websites, ETF Trends, ETF Database, Advisor Perspectives. I'm probably forgetting a bunch. And we do an enormous amount of advisor education. We do over 200 webinars a year, talking about every aspect of the financial advice business with a pretty heavy lean on ETFs. And we run the Exchange ETF conference down in Florida every year in February, which gets together a couple thousand financial advisors to talk about everything from how to run their practice to whether or not they should buy XYZ ticker, which seems insane this week. So that's what Vetify does. My job as a financial futurist, which you're allowed to laugh when you say it out loud, because I laugh when I say it out loud.
Sorry, I just did it again, and I didn't even mean to.
You've been holding it in. I appreciate it. So that's a funny title that we came up with. That basically means I spend most of my time talking to financial advisors and issuers about what they're looking at beyond this year. So I tend to say that, a market strategist tends to be focused in 1 to 3 years. Certainly a portfolio manager tends to be focused probably even shorter term than that, even though they'll tell you something different in the prospectus, generally focused on that short time frame. What I'm generally focused on is more like 3 to 10 years out. So I'm one of those people who's still interested in things like decentralized finance. Remember we used to talk about that a couple of years ago? Yep. I'm still focused on things like that. The Bitcoin ETF has obviously been a big topic of conversation lately. I'm deep in those weeds as well. So regulation, market structure, and then frankly, the culture of investing and how that drags people forward. So that's sort of my shtick. Mostly I do a lot of publishing and I do a lot of videos and I do a lot of talking to people.
Cool. Well, my first, what I thought was an ingenious question, is not 7 to 10 years out. It's actually 2024.
I know, actually, that is very interesting. But our focus is much more limited because we're much less visionary than you are. But we are interested.
We're financial present
We're
Well, this present is worth spending some time on because 2024 is a wild ride.
Yeah,
Oh,
well,
2020, God knows. God knows it is.
It should be a doozy. Obviously, when you think 2024, you think the election, right? It's on top of everyone's minds. And
I think I can speak for everybody by saying, regardless of what your political leanings are, we're probably all dreading the prospect of the election coming up at the end of the year. But it may obviously a lot of volatility potentially associated with that. So how do you think about the election and hedging against it or playing the election, or is there even a point in trying to do that?
I get this question a surprising amount, and I get it religiously every 4 years, unsurprisingly. Everybody always wants to, quote unquote, play the election. I think every trader has a theory that they have about who's going to win based on these tea leaves being read. The conclusion that I've come to over the last dozen election cycles I've had the privilege of looking at is that it's really a mug's game, to use an old man term. It's a fool's errand to try
Now,
to...
that's an interesting term, a mug's game. I've never heard that before. Is that
I think
like a
it means
Canadian
I'm
thing?
90.
are you fucking serious?
Yeah. No, I've never heard that.
Mugs game, like horse race betting.
Okay,
like
all right. I just hadn't heard it.
It's a pointless exercise, right?
Yeah.
It's only for fools. I think if you think
it's funny that Dave said that's like an old man's term, and Dave,
don't do it. Don't go there. Don't go
sorry,
there.
that's not what
you're like.
How did you read into me like that? That's not what I meant.
Anyway. Sorry, Dave. Anyway.
Sorry, Dave.
Yeah.
I apologize for John.
So
it's a mugs game.
It's a mugs game. What I tell advisors is don't try to trade the election, right? You should have a portfolio that you feel comfortable holding no matter what happens over the next 18 months, right? And let's be honest, if everybody really think this election is going to be over in 11 months, I don't. I think this is going to drag out forever, at least the implications of it and the ramifications of it, whichever ways it goes. But there are plenty of folks out there trying to sell you on things based on what your belief system is about the election. We have products like DEMS, which is literally the Democratic Large Cap Core Fund, which is designed to position based on regulatory differences between the two parties. And while I understand that, this is one of those cases that I think all of this is priced in every second of every day.
Sounds a bit gimmicky, but you are not. You are not one of those like gimmicky get rich.
So DEMS is that really a real life ETF?
Yeah, DEMZ. It's a real life ETF.
Okay,
there's Ramaswamy has a whole ETF company called Strive, which is basically trying to build sort of GOP oriented ETFs. More oil drilling, things like that.
And is the thought that you pick one and the winning party, your ETF will go as up. A result increase? Really?
That's the thought. I'm
learning something every day, my man.
I'm a stellar on this narrative.
I'm with you on this, Dave. I think it all sounds whack to me.
And historically, this doesn't work. We've been the last election cycle, we had a whole raft of we had a GOP ETF. I think it was actually called GOP. Didn't work. Doesn't matter really how you position things. I believe that this kind of information gets priced into security prices so quickly. We see this as we've all done this before. We'll get into September this year, and you'll see the market reacting based on weird poll numbers, or somebody will have a Dean scream, and all of a sudden they won't be in the mix anymore, and everybody will move the market. But the idea that you can position your whole portfolio for the long term to lean one way or another seems very silly, and also really a violation of what most advisors should be doing, which is really having a prudent plan for the long term.
Well, that makes sense to me.
Is there a MAGA one?
I'm sure if there's not, then somebody will create it because there's money to be made from it.
I don't think that
if you can make money off of people's ignorance.
Wait, I got to trademark that. Sorry, nobody used that out there.
Yeah, yeah, right. Yeah,
no. We have the Point Bridge America First ETF, MAGA.
Really?
Well, there you go.
Yeah, it's all out there.
Sorry, Ronan,
bastards.
Yeah, you missed your window. Well, speaking of which, so one of the trends that has become political for weird reasons that I don't really understand is ESG and clean energy and all of that, right? In fact, I just read an article the other day that CEOs are being counseled to sort of stay away from using the term ESG. So basically, do what you're going to do anyway, but just don't use the term so you don't attract unwanted attention. How do you see those investment trends around those factors What's the state of that, and what's the trend of that in 2024 and going forward?
Well, we had a pretty bad year or two in terms of things like flows. So we went through the very early beginning of the century that we're in, a big push in the ETF community, selling lots of different varieties of ESG. And I think that was a bit of a hype train. And I think we all saw that was a hype train when that was going on. And I think there were very legitimate criticisms of how the packaged product market jumped onto ESG. In particular, a lot of the stuff got really watered down, right? You look at these portfolios that look almost exactly like the S&P 500, but they have some tiny little screen in them, and you can charge another 10 basis points that you couldn't charge when you didn't have that tiny little screen in it. That, I think, has largely moved off to the side a little bit, and we've seen negative flows in a lot of those types of products, particularly here in the U.S. The counter to that is it hasn't actually stopped these things from working. The average sort of boring ESG fund, like S&P 500 with an ESG tilt, they all outperformed the S&P last year. Nobody's talking about it, but ESG worked. And so I think what we're going to see is the sort of slow growth will continue largely outside the United States. I think it's very easy to be US-centric about this and think, well, our trillions of dollars aren't going to get allocated to this because we're American. It doesn't matter, right? The Nordic sovereigns, even like the Middle East sovereign funds, they're throwing money, particularly into climate-oriented solutions because they see the writing on the wall. I mean, it is only going one way. Is the ESG way that Wall Street created the best way to tackle this problem? Probably not. But there are valid ways of doing this. So the idea that we're going to have boardrooms stop using the phrase ESG and probably DEI as well, given what we've been seeing lately, doesn't mean that they aren't still valid economic factors and we won't see people continue to invest on them. I suspect we'll see much tighter focus on the G, governance, because that's one that's made and saved people a ton of money. Just getting out of the way of stuff that blows up is a good idea. And a lot on the E, a lot on the environmental stuff. The social stuff, I think, is going to be sort of relegated more to values-oriented investing, which again,
harder to benchmark, harder to objectify and sort of figure out whether you've met it or not. Yeah,
very personal.
But the environment makes a ton of sense, right? I have to imagine.
Well, and tell me if you disagree. I assume that part of the premise here is that on a longer-term basis, the objectively investment performance has to be based on rational factors, not political ones, not short-term political ones. And longer term, we, as a society and globally, economies have to be oriented toward longer-term, more sustainable energy and other sources.
Yep. And I think we're going to continue to see focus on, it's a decarbonization, carbon credits. Nuclear, I think, is going to go through a real renaissance here in the next couple of years. One that I think is actually investable. I think I've been talking about NLR, which is a fund from Van Eck that is both the nuclear energy industry, so the actual people producing power and taking advantage of some of the subsidies we've now got in the U.S., but also some of the uranium miners and the folks building the technologies. Most of that stuff's pretty beaten down. Like nuclear has been a no-no for a lot of investors for a long time. But we've seen in Europe it's taking off. We've had France talking today as we're recording this about increasing the number of reactors they need to build in the next 5 years. So I think there are pockets here in the decarbonization trade that are really investable.
And if people can ever figure out how to actually harness the fusion sort of aspect of nuclear energy, then that's obviously a complete game changer.
Yeah, absolutely.
That's a hot take.
Yeah.
Well done, John.
Hot take.
Yeah, if you can invent the fucking time machine, it'd be cool too. Sorry. So as we record this, a previous podcast guest of ours, Anthony Scaramucci, is currently staring at the clock,
otherwise known as the mooch.
The mooch, waiting on a decision which is supposed to come by tomorrow, right, from the SEC, but it's regarding
many other folks. Yes.
Spot Bitcoin ETF.
You may have heard of that, a spot Bitcoin ETF, perhaps.
Yes. It's very hot to trot in it, and the market seems to be trading like it will be approved. Possibly Ethereum. I don't know when that might be, but what impacts do you foresee on the crypto market? How should investors be approaching these digital assets when there's really no clear direction from, I'm trying not to knock our regulators, but clear direction from our regulators.
Don't knock
the
our
regulators all day
regulators,
long.
Ronan, for God's sake. How many times do I have to tell you?
Dave, if you've listened to this podcast, more than 2 of them, you've probably heard the declaration from Ramsey as to how long he's worked at the SEC and the FINRA.
Let's move it along. Move it along.
CFTC.
Yeah, just move it along.
Yeah.
I was giving him an in. Sorry, Dave.
Here's my hot take on the Bitcoin ETF thing. So yes, they're going to be approved. I think it's hilarious as a long-term market structure and regulatory wonk that all of a sudden all these people who know nothing about regulation think the SEC has to follow a particular calendar. You guys know how ridiculous that is. There's this belief system that somehow if it doesn't get approved tomorrow on the 10th, that Gary Gensler is going to get hauled away to jail or something like that, not realizing he could simply say, we'll get to you next week, and nobody could do anything about it, which is what the SEC usually does.
Yeah.
But regardless, I think they've been backed into a corner enough now because of the lawsuit, which they lost against that Grayscale won against them, that they are going to approve it. I suspect that tomorrow a bunch of those final approvals will in fact come out, and then we'll see the normal process of everybody scrambling to get their product actually trading on an exchange, which is never at 9:30 on the open, even though everybody always thinks it's going to be like, they'll all be trading at 9:30 on Wednesday. I suspect they'll all start trading sometime between 9:30 tomorrow and the end of the month, because everybody's going to have to get all their ducks in a row. So they'll be trading. I think it's a big deal for the crypto ecosystem because all of a sudden, a whole lot of financial advisors who use model portfolios can quickly allocate 1 or 2% if they want to into Bitcoin. A whole lot of institutions that are trapped in other mechanisms like GBTC have a better vehicle to move into. So I think it will be a big deal. And I think we'll see, somewhere under $10 billion in net new assets flow in by the end of the year, which sounds like a big number until you think that like JP Morgan's equity premium income fund pulled in $22 billion last year, right?
But
so I don't think it's a big deal.
But sort of like all these expectations are priced in, so it's not going to be like earth-shattering or game-changing.
Well, I'm not going to sit here and try to give you a price target on Bitcoin. I know that we've got a mark out there from, I think, Standard Chartered for 200,000 by the end of the year. Well, I mean, I don't know. Can anybody really make predictions like that? I think the number go up.
Well, I would think you could. You're the financial futurist, right? I mean, if you can't, then who the fuck can?
He's got a magic 8-ball right there. Come on, tell us.
I think the number is up from here. The combination of the halving going which is a real thing, and the increased access from a new audience suggests that, yes, the number should probably be up from here. I don't think it's $100 billion in net new flows and 5 times the price.
Yeah. But help me understand something around this. I feel kind of ignorant about this. When people talk about the Bitcoin ETFs, and there's all these people that are like, chomping at the bit to, put in their own product. How much differentiation can there be? Bitcoin ETF basically means you just take a bunch of Bitcoin and put it into a fund, and then you have a way of trading it.
It's
is there something really that much more nuanced than that? I mean,
3 things: price, liquidity, marketing. Those are the only things that are differentiating any of these products. On price, we know Bitwise is going to be the cheapest. They're at 20 basis points. That makes them the likely target for things like institutions and models from financial advisors. We know that BlackRock is launching something, and because they're launching something, we know that we have a 200-person capital markets desk, which is going to go put nuclear weapons aimed at market makers to make sure that it trades really well. And so I would sort of put the horse race between those two and GBTC, which already has $28 billion, but is a pink sheet trust right now. So those 3 will jockey for position, and then the game will become who gets the options trading. And if the options all lean on one ticker very quickly, that's the ecosystem.
But you're not going to have dozens of these products.
No. I would suspect a third of these products will close by the end of the year, and another third will dribble along well underneath profitability for a year or 2 after that.
Yep.
Very good question, John.
Thank you. Thank you, Ronan.
But hey, it's Bitcoin. It's the future of finance, right?
Yeah.
To the moon.
Whatever.
To the moon.
Yeah. To the moon, Alice.
And another, I don't know if I can, another one, if I can, I don't know if I can call it a buzzword, but like active ETFs is pretty hot topic. Maybe last year, maybe I'm late to this, but there's talk of it slowing down, maybe underperforming. And we thought maybe you'd be a good person to elaborate on the challenge of active ETFs versus index funds like the old Qs, boring things like that. Like what?
Yeah, we definitely had a renaissance in active management over the last 18 months. fully like 80% of the products that launched last year were actively managed. Something like 20 to 25% of the flows went into actively managed products. And so they were
from big, legit firms, right? Like the T. Rowe's of the world and things like that.
JP Morgan. Right? I mean, these are real large firms.
Yeah.
Obviously, firms like Cathie Wood's ARK are in that mix as well. And I point out that, like, despite the fact they didn't get a lot of flows, if you actually start looking at league tables, like Cathie Wood's financials fund outperformed financials by 35% last year, and nobody's talking about it. Their web-based fund outperformed everybody else's tech fund that wasn't just pure Bitcoin or digital mining, but nobody cared. So that, I think,
why is that? You think, is it just people want to pile on her funds that haven't done well, or like
there's some of that.
That's all I read in my Bloomberg. It's like,
there is definitely a sort of a cultural component to this. People love jumping on people when they're down, and Cathie's they've been so aggressive with their.
She was so up, and then people want to like rain on her. It seems
exactly.
Like,
so I always try to tell people, like, they did exactly what they said they were going to do, and if you were surprised by any of it, you weren't paying any attention. I actually think that they make some good calls here and there. I think they are a shoot from the hip active manager in the old 1990s trading style. And sometimes that works and sometimes it doesn't. So it's a regime dependent kind of bet. I think that those bets are getting harder, not easier over time. The more money gets plowed into things like ETFs, which are easy to trade, easy to express your opinion with, the harder and harder it gets to be the person who's pulling out the specific gems out of the overall market that nobody else has found out about, particularly with the index effect driving momentum into the Magnificent Seven. I mean, remember, we're still in an accumulation phase in indexing. Target date funds are still net buyers of the whole market. That just gets the winners richer over and over and over again until we start decumulating in the next 5 to 10 years from the baby boomers, in which case we should be a little bit more cautious.
But you're always going to have people, presumably, who are smart at being able to understand the fallibilities of sort of herd mentality and figure out where the herd's getting it wrong and figure out how to differentiate themselves. And otherwise we're just all turning into automatons. Right?
I think people can still beat the market. I'm not sitting here saying that's impossible, but I think that people start to understand the math of how difficult it is and how unlikely it is that you're the guy who managed to find it in an ETF wrapper, as opposed to being locked inside some hedge fund that you probably can't get access to, or a mutual fund that can close, that's closed for new money. Right, that's the other thing. ETFs can't close. So if you've got really fantastic ideas in the microcap space, you can't launch an ETF on it.
That makes sense.
Yeah.
I thought we'd touch upon yet another buzzword, if you wouldn't mind. And it's, 23 was the pivotal year for AI. Obviously,
AI.
Let's talk about AI.
Everybody, we've heard of AI, but that's his AI seance. Don't worry. But like 23, it really came to light, right? Where, my little mother in Ireland probably talks about AI. But as we move into 24, as maybe that's the implementation year where people actually really use it for what? I don't necessarily know. What do you predict for AI in the financial sector, and how should investors and advisors prepare for
including in the area you're most familiar, creation of ETFs and tools for asset managers.
Look at that bridge he just came up with. Love it, John.
I love it. So here's the thing. I'm not a big buyer on the idea that AI is going to pick stocks real well. And that's a giant bucket of AI research. It doesn't mean that they're not going to be helpful, but I don't think that somehow we're all going to magically jump into the AI S&P 500 and it's going to beat the regular S&P 500.
God. I'm glad to hear that.
I just don't think that's how it works. Do I think that there are a bunch of firms on the South Shore of Connecticut that are going to use AI to good effect in the data analysis work they do, particularly around things like consuming large volumes of language, like, say, regulatory filings or news flow. Those things are legit. And I think that there'll be interesting sources of signal for folks that are already very good active managers and already very good stock pickers. But the real impacts of AI that I think we're going to see this year are going to be much more subtle. It's not going to be OpenAI and Microsoft and Google. It's going to be things like Disney right? Disney is going to be able to start saying, oh, you know what? We have a couple of little kids properties that are largely AI developed that generate a bunch of traffic. We have AI doing better jobs of doing recommendation engines. Oh, by the way, in our corporate office, we've managed to get rid of all of our paralegal staff because that's all being done by somebody else now. So there are these jobs that I think will start to have direct AI impacts, but it's not going to be like overnight there's a paperclip factory and we take over the world. I think it's going to be much more subtle than that. And frankly, I'm hoping that the hype has died down enough that we can start doing some of that actual development work. I think it's a distraction when we have these hype cycles. I think the AI promise is very real. I think it needs to be matched up against the real world. So that means robotics and automation. And those things take a little bit more time. Like material science takes a little time. You don't just develop that overnight in a code release.
And experimentation in targeted ways. And you have to sort of like figure out what works and what doesn't. The important thing is that I think Ronan and I do not become irrelevant or cannot be.
We need humans on the electronic trading.
Yes, we can. Yeah. Well, actually, the truth is we already have a bot that has taken over Ronan's.
Well, but we've
job.
seen
He
this
just
in
doesn't know it yet.
Yeah.
In trading and investment management. We've been at the front end of this trend for decades. I mean, think about how many people used to work in a custody shop in the 80s or the 90s, right? Think about how many analysts you needed to be able to cover the S&P 500 and before times when you couldn't just pull up a quick summary on something. So I think finance is way ahead on this stuff. And that actually means I think we'll be less affected than some other industries. I think things like news reporting and the advertising supported media model, those things are really challenged. I think finance is largely fine.
Yeah, I'm not saying that we, like in our business, can't get anything from AI, but like to your point, Dave, like, I mean, we've had we'll call it more a machine learning signal in operation on our exchange since 2014. And when, we've asked the quants, what could we do with AI to make that signal better? And when you look at Wall Street, and particularly equities trading, we're at such a speed game in terms of microseconds where a lot of AI could probably do things to augment a model, except they're just nowhere near as quick.
Right.
So there's different uses of it, but like I agree with you.
Wait, it sounds like you need a speed bump.
Yeah,
Well,
we need to make it a lot bigger. Unfortunately, 350 microseconds almost caused world fucking war when we filed to be an exchange. But we might need a few seconds to be honest. But no, but you're right. Like things like people have been looking at like elementalized news feeds for years. Like when economic information comes out. But to your point, using AI to really digest what's reported, that could be something that's interesting.
My sort of contrary opinion on this is that I actually think AI is going to teach us not to trust stuff even more than we already don't trust stuff. We're going to learn that real hard in this election cycle.
It's AI spam.
But that puts a huge premium on what you guys and what I do right now, which is authored content, you know where it comes from, you know where the biases are, you know what the context is. I actually think we're going to see a golden age in people actually caring about where their information comes from.
Look at that, the financial futurist. I keep saying futurist.
Futurist.
I'll be a futurist.
The financial futurist is saying John Ramsey will have a job by the end of 24.
Thank God for that. Well,
I mean, if we don't, we're all going to be unemployed, in which case we can get on the breadline together.
That's true. That's true. Do you want to talk T+1 settlement, John?
I guess. I don't know. It seems like are
you saying that's boring
considering all
compared to all
this
the other
like
cool
elevated stuff we've been talking about?
Yeah.
It feels like a bit mundane and prosaic.
Well, except everybody thinks it's going to end the world. You guys don't think it's going to end the world.
I know, but it's not going to end the world, right? No. I mean, so SEC has mandated a transition
Futurist.
to Futurist.
We were not drinking.
We mandated Futurist.
Yeah, holy shit.
T+1 settlement. So that's upcoming, May of 2024?
Yeah.
Jesus. So are people ready for that? And are there, so a lot of people have been making this discussion of kind of like the difference between the US and Europe. The US has gotten out in front of it and is going to create all of these problems in terms of cross-border settlement, et cetera. How do you think about all that?
I feel like we've been dealing with this problem since the 70s as well, right? And we keep doing it over and over again. I think the big message here is that advisors, in particular, my audience, should not pay any attention to what will be an inevitable doom and gloom hype cycle in April, right? Mm-hmm. Unless something else is really interesting happening in April. April happens in this sort of gap in some of the election stuff. It's not Super Tuesday, et cetera, et cetera. So what are they going to write about? They're going to write about the impending T+1 transition and why that's going to create market disruptions, et cetera, et cetera. It's just like Y2K to me, where
I was going to say that. I remember that.
But I'm already reading articles and getting calls from reporters that have that same tenor of like, tell me how to make this really a big deal. And I'm like, yeah, if it all goes horribly wrong, that would be a big deal. This is also like the most well understood transition in financial services history that I can think of. Everybody knows this. Everybody at the custodians I've talked to knows what's going on. There are going to be some differences in terms of who's holding water on trades. Absolutely. Does that mean some people lose a little money? Some people make a little money? Sure. But that happens every time we touch market structure in any way. So,
but see, that's the problem with talking to reporters, as you know, now from having talked to them, is that if you don't feed them and give them enough, kind of like ammunition as to why this is going to be earth ending, then, why would they want to talk to you?
Fair enough. Well, then I guess I won't get any quotes because I've been telling everybody, I just don't think it's that big a deal. Look, it's not a big deal. It is a significant change to market structure in the settlement clearing process, but I think it's on the way towards, bearer bond settlement, which is eventually where all of this goes. At least some markets become instantaneous settled, like crypto. Yeah, but I try to convince people that the world's not ending. It's never a good look.
There's I'm not even smart ass now. There's no ETF crafted around this one way or the other, is there?
I think you have to just like short BlackRock or something like that.
And we say Wall Street's not betting. Anyway, all right. Well, we have a fun question for you.
We have a fun question.
Yeah, we used to ask a fun question, and then people found it on fun. So now we have a different fun question. Interested in your answer to this. If you could give a one-sentence piece of, it can be longer than one sentence, but if you could give a one-sentence piece of financial advice to your younger Dave, what would it be?
A bit of a philosophical question.
It is a bit of
requires some introspection.
So hopefully we asked you this question and we're not just blindsiding you here.
No. I have thought about this. So I have to think about my younger self who actually thought about money, and that was me probably in like my early 20s. So dating myself, that would have been 90, something like that, 89. And I was an incredibly fearful investor at that point. My first dollars into the market came in right before the crash in 87. That was real fun.
Well, that'll do it to you.
Yeah. And it wasn't a lot of money. It was like $1,000 or something like that. And it simultaneously gave me an enormous appreciation for market structure because I went down that rabbit hole and learned everything I could from the SEC report and all that. So I was deep in that well from 87 to 92. But as an investor, despite the fact that it launched my career, I invested with nothing but fear, probably right up until 1998, when all of a sudden I decided to put a bunch of money to work and then I lost that instead. So I would tell myself not to invest from fear. I think that's always a mistake.
Well, there you go. Very, very wise.
I probably should have invested with fear because I lost my fucking shirt. But speaking of attire, watch this bridge. Dave, would you like yourself a pair of IEX comfortable socks?
I would love a pair of socks. I would love a pair of socks.
We could send you other swag too. But
swag. Honest to God, I'm a little worried that there's something wrong with John today. This is like his 10th mispronunciation.
We should call a neurologist.
Usually think it's wrong with me.
Yeah, normally I pronounce shit wrong and he sits there, but oh my God.
Yeah. Anyway, we give out socks.
I love,
and they're beautiful
socks.
We will.
I'm actually wearing a pair of socks, but I
am wearing a
I tried to show you.
Yes,
that's true. But you're going to get the greatest pair of socks ever. How many times can we say socks on a podcast?
And we're not even talking about semiconductors. Who knew?
There you go. Boom. Dave's bridging.
He's very quick. We rarely have.
Well, I can see the future, so that helps.
He is a futurist, after all.
He is a leading futurist. Yes.
Well, Dave, listen, man, we appreciate you being on the podcast. You've been a fantastic guest.
A fantastic guest.
Maybe we'll call him back in. What if in 12 months, though, he's totally fucking wrong? Can we bring him back here and show?
Bring me over the coals.
Get another pair of socks. They should be wearing out by then. Socks.
I do own more than one pair, but that's okay.
So maybe, Dave, you will be our resident futurist for our beginning first of year podcast going forward.
I love it. I love the idea.
Yeah. Bingo. Cheers, man. We really appreciate it.
Thanks for having me.
Box and Lines over and out.
God bless
us, everyone.
See you soon.
Bye now.
Goodbye.
Are you a diehard boxer or airliner, or just a fair weather fan? No judgments, I know how annoying JR's Irish accent can be. Either way, we want to hear from you on our new Boxes and Lines listener survey to find out what you think about the show, give input on future episodes, guests, and more. We'll take it back to our survey counter thingy machine and consider all of your inputs as we plan our 2024 season. You can find the survey at iex.getfeedback.com/boxesandlines. And don't worry, there's something in it for you. That's my drum roll. JR could probably do it better. You get a pair of socks. That's right, take the survey, we'll send you a pair of our coveted Box and Line socks while supplies last in a new limited edition print. How's that for listener appreciation? So take the survey, tell us what you think, and thanks for listening. Again, that's iex.getfeedback.com/boxesandlines. Over and out.
Boxes and Lines is a podcast from IEX Exchange. It is hosted by Ronan Ryan and John Ramsey. Executive produced by Daisy Clace, with support from Benstown. For more information and to hear more episodes, go to iexexchange.io/podcast. Thank you for listening to Boxes and Lines. The information and opinions expressed in this podcast are provided for informational and educational purposes only, and IEX Group Incorporated and its affiliates do not make any representations or warranties as to the accuracy or completeness of the information contained in this podcast. Nothing in this podcast constitutes a solicitation or offer to buy or sell any securities or provide any investment advice or service. Some portions of the preceding conversation may have been edited for length or clarity. Copyright IEX Group Incorporated, all rights reserved.